All right, today we're tackling a massive topic, leverage. It's this powerful force that can, build incredible fortunes, but it can also shatter them in an instant. And we're going to look at it through the lens of a story that everyone in finance thinks they know, the Harshad Mehta era. But this isn't a history lesson. This is about using that story as a blueprint to understand the leverage traps that are sitting on your trading screen right now.
And that really is the core puzzle, isn't it? We've all seen the shows, we've read the articles. It's so easy to look back and think, "Pih, I would never have fallen for that." But the truth is, the tools have gotten slicker, but the underlying physics of leverage, and frankly human psychology, haven't changed one bit. What we're going to explore isn't about one man's greed. It's about the market structure, and how that structure enables and then punishes the timeless search for bigger and faster returns.
Exactly. So to really get what's happening today, we have to deconstruct yesterday. We're going to get our hands dirty and look at the actual system that made it exploited. Not the big, flashy headlines, but the nuts and bolts, the actual gears of the market that he figured out how to turn.
Okay, so the engine for this whole thing was something called a ready forward deal. Now, on paper, this was supposed to be incredibly safe. Think of it as a super formal pawn shop for banks. One bank needs some cash for a short period, so it gives government bonds to another bank as security for a loan. It was the bedrock of how banks manage their day-to-day cash flow, and it was designed to be almost totally risk-free.
But, and this is the crucial part, there was a huge flaw in the system. Back then, moving the actual physical bond certificates from one vault to another was a logistical nightmare. It took weeks. So to get around this, the banks used an IOU called a bank receipt, or a BR. It was basically a piece of paper that said, "Hey, I promise I have the bonds, you've paid me, and I'll get them to you eventually." The entire system ran on the simple trust that a BR was as good as the bonds themselves. Mehta realized this trust was the system's greatest vulnerability.
And this is how he turned that vulnerability into a nearly infinite money machine. First, he got a few smaller, struggling banks to issue fake BRs, literally IOUs for securities that didn't even exist. Then he'd take these worthless pieces of paper to bigger banks who lent him enormous sums of money, thinking they had solid collateral. He then funneled all that borrowed cash straight into the stock market, famously pumping up stocks like ACC from 200 rupees to over 9,000. But the final move was pure genius. He used the inflated value of his stock holdings as collateral to borrow even more money. It was a perfect self-feeding loop. Borrow, pump the stock, use the inflated price to borrow more, and repeat.
Okay, so I get it. Fake receipts and slow paper settlements, it sounds like ancient history. But that cycle you just laid out, borrow, buy, use the paper profits as collateral, and then do it all over again, that is happening every single second of every single day in today's digital market. The physics haven't changed at all. We've just swapped out the old analog tools for sleek, new digital ones. And this chart just nails the comparison. Instead of a fake bank receipt, today's trader uses margin trading facility or futures and options.
Right.
And the friction that's being exploited isn't a long settlement delay. The friction today is the interest you pay every day and the constant threat of a margin call. The collateral isn't some non-existent promise. It's the very real share sitting in your DMAT account that you've pledged. The result, though, is exactly the same, amplifying your cap.
So if the behavior is identical, why couldn't someone just pull off a carbon copy of the 1992 scam today? The answer is really simple. Technology completely eliminated the single most important ingredient in Mehta's recipe.
Mehta's entire operation depended on something called the float, that weeks-long gap between when a trade was made and when the money and shares actually changed hands. That delay was his playground. But as you can see from this timeline, we've spent the last 30 years systematically engineering that float out of existence, dematerialization, T+1 settlement, and now we're moving towards T+0 or same-day settlement. There's simply no time lag left to hide in. Your broker's risk management system knows in milliseconds if you're good for the trade or not. That specific game is over.
Okay, but this is where the story takes a really fascinating turn. We solved the problem of one big bull being able to break the system.
But the risk didn't just disappear. It mutated. You could say it's been democratized. The fragility in the system no longer comes from one huge player. It comes from millions of small players all doing the same thing at the same time.
And that is such a critical point. We have this false sense of security because, SEBI's stronger, everything is digital, so we must be safe. But the new rules only changed the form of the risk. They stopped one person from being able to use a fake IOU to trick a bank, but they did nothing to stop a million people from using very real leverage to create a cascade of margin calls. The physics of a crash remain exactly the same. And if you want to see the brutal reality of those physics in action, here it is.
This isn't a guess. This is hard data from CB. 91%, 9 out of every 10 individual traders in the F&O space lose money. Now, when a number is that high, you have to stop blaming individual mistakes or bad luck. That's evidence of a structural problem where retail is consistently on the losing end of the game.
So if retail is losing, who's winning? This chart lays it out in black and white. It's the proprietary trading desks and the foreign portfolio investors. And their edge isn't just that they're smarter, it's technology. Somewhere around 96 to 97% of their profits are generated by high-speed, algorithmic trading. They are, quite literally, bringing a supercomputer to a knife fight.
And this is what makes that statistic even more alarming. Look at who these traders are. A massive 76% of them have an annual income of less than 5 lakh rupees. This isn't the story of high net worth individuals taking calculated risks. This is overwhelmingly middle and lower income folks chasing quick returns in a system where the odds are just structurally stacked against them. A big loss for them isn't just a setback, it can be catastrophic.
So, knowing all of this, what's the takeaway? How should you or I think about leverage? This isn't about saying never use it. That's not helpful.
Not at all. It's about having a much better mental model for understanding exactly what you are getting into. We want to give you a thinking framework, not just another generic wording.
Okay, so before you ever take a leverage position again, just run it through this quick 3-question audit. First, what is the true cost of this position? Don't just look at brokerage. Factor in the interest on your MTF loan that ticks up every single day. Factor in the time decay on that option premium that's melting away like an ice cube. These are hurdles you have to clear just to break even.
Second, and you have to be brutally honest with yourself here, is my trade based on a real, verifiable edge that I can articulate, or am I just buying because the price is going up and I'm hoping it continues? Hope is not a strategy.
And finally, this is the most important one. What happens if everybody tries to do what I'm doing right now? That question forces you to think systemically. If your entire strategy relies on you getting out the door before everyone else rushes for the same exit, you aren't really trading, you're just playing a game of musical chairs.
Which kind of brings us to our final thought here. Harshad Mehta was dubbed the Big Bull because he was this one singular person who could move the entire market. But today, with frictionless tech and leverage available to millions at the click of a button, maybe the Big Bull isn't one person anymore. Maybe it's the crowd itself. All of us, together, amplified into one powerful, unpredictable, and potentially very fragile force. And that's something to think about.